Hello everyone, welcome to Demand Supply Trading Practical Session number 19 for the year 2025. Myself Sujit Kakkar, and today is Sunday 11th of May 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you for the schedule of these sessions. Plus, if we have any content related to demand and supply, which we want to share, we also share on that particular channel. So in case you have still not joined this channel and you wish to do that, a few different ways it can be done. First, whatever QR code you see on your screen, you can simply scan it, and by scanning this QR code, you can join the Telegram channel. The other option is in the description. You'll be able to find the direct link, and by using that direct link, you can also join the Telegram channel. And whenever you visit our website, which is sujivkakkar.com, or you can use the short URL, which is sk.coach. So whenever you're on our website, you can just scroll down on any of the pages, and at the footer, you'll be able to find this option which says join Telegram channel, and you have the join now button. You can click on this join now button, and you can be a part of that Telegram channel. Now, today's session is a practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now 100% free. Now, how can you access the course? We'll talk about it as we move forward. But once you go through the course content, you basically learn the methodology theoretically, right? What is demand supply, how it has to be applied. So you learn all the nuances of demand and supply in a theoretical fashion. But unless and until we look at some practical examples, right? At times we don't get a very good understanding of how it has to be implemented. And that is what we do in these practical sessions. So every weekend I do a practical session where whatever we covered theoretically, we apply it to some practical examples so that we can understand how to plan trades very mechanically and rule-based. Now, the best part about these sessions is that we are not analyzing something which has already happened, because like I always say, that's a piece of cake, a move which has already happened. You can pick up any chart, apply a number of indicators, oscillators, and you can find a number of reasons why you could have participated or why you could have not participated. But demand supply is also known as set and forget methodology, which means you can pre-plan the areas where you would like to be buyer and seller. And in future, when the prices, they revisit those areas of demand and supply, that is the time those trades, they get triggered. And since they can be pre-planned, that is what we do in these sessions. We do our analysis in advance. And whenever in the future prices, they revisit those areas of demand and supply, we also review them. So that this helps you see both the before as well as the after, and that helps you build up confidence in the methodology. So again, today's session will be the practical application. Now, to feel comfortable in these sessions, there are some prerequisites, and if you people will complete those prerequisites, these sessions will be much more easier on you. So let's understand what these prerequisites are. The very first one is our trading essentials course. Now, why it says optional? Because if you already have a very good trading background, probably if you want to skip, you can skip it, though I would still recommend you go through the trading essentials course. But if you're starting as a fresher, then definitely you should be going through the trading essentials course. So now, how do I access the trading essentials course? Very simple. Once you're on our website, on the top under services, you'll be able to find the option which says courses. And here you can see the very first course is the trading essentials. Click on it. And the course is available in 2 languages, English as well as in Hindi. So once you click on these buttons, it will straight away take you to the playlist of these courses. No subscription required, no registration required. You can access the course content immediately just by clicking on these buttons. So the course is laid out very systematically for you, lesson 1, lesson 2, lesson 3. So just go through all the lessons in whichever language you're comfortable with, and that basically covers your trading essentials course. Now, once you're done with trading essentials, the next step is to learn demand supply methodology. Now, how can I learn demand supply? Again, very simple. Once you're on our website, under services, you'll be able to find courses, and here you can see the second option is demand supply trading. Click on it. Now, this course is also available in both languages, English as well as in Hindi. So whatever language you're comfortable with, you can choose as per your preference. But these lessons will cover the course theoretically, right? So what is demand, what is supply, how it has to be applied. Now, if you want to see some practical examples, you can click on practical sessions, and this will take you to this page from where you can access the recordings of the past sessions. So whatever practical sessions I do, we also keep an archive of all those, the recordings of all those sessions. So here also you have the option to watch the English sessions or the Hindi sessions. So that will help you cover the course both theoretically as well as practically through the recordings of the previous session. Plus, like I said, I also do these practical sessions every weekend where you can also join in live. So that basically covers the first two prerequisites. The next thing is when you see me doing the analysis during these practical sessions, I use two documents. One is the rule book and the other one is the flowchart. So how can you access these documents? Again, very simple. Under services, you'll be able to find downloads, and under downloads, you can see the first one is the rule book. The second one is the flowchart. So you can download from here, and that's your rule book and that's your flowchart. Perfect. So that basically covers all the prerequisites, and now we can start with our session for today. Now, before we take today's example, we do have one example from the past which got triggered during the week. So we'll do the review of it, and after reviewing it, then we'll start with today's example. And talking about today's example, I would also like to add that, currently we have an archive which is almost about close to 1.5 years. But this is the first time I'll be taking an example which we haven't taken in the past, and we'll understand what that example basically is. So today's trade will be more of a conditional trade. Now, why it will be a conditional trade, once we do the analysis, you'll get the answer to it. But it's a example which we are taking for the very first time, right? Because at times finding such examples can be a little bit challenged. So I had almost a textbook kind of an example. So I thought, why not pick it? And that is the reason I also said that this is going to be a conditional trade. We'll talk about what those conditions would be. All right, now starting with the review, this is your session number 16. Just give me a second. Right, so this is your session number 16, which was on the 20th of April. Now, when we did the analysis for this particular symbol, we had a score of 10 out of 10 for quality and 1.5 out of 8 for probability, which made it as a type 2 or a type 3 trade. Now, while we were doing the analysis, we did not have a 4:1 move. So that is why we gave it a score of 0 for the move from the zone. But you can see when the prices, they started coming back, we already have a move which is almost 4:1. Therefore, the score from 1.5 out of 8 would have upgraded to a score of 3.5 out of 8. But it will still make it as a type 2 or a type 3 trade, because this is still a low probability setup. For a high probability setup, we need at least a score of 4, which would have not happened. So this would remain as a type 2, type 3 trade. And how do we take a type 2, type 3 trade? We wait for the prices to come inside of the zone. Then we wait for a bullish or a very bullish candle, again, depending upon your personality style. If you're very conservative, then a very bullish candle can be a trigger. If you're not very conservative, then even a bullish candle can do. And for that bullish candle, we have to go to the refining time frame, which in this case would be the hourly chart. So you can see, yes, we definitely came into the zone, but we never had a bullish candle inside of the zone. And the very next day, prices, they just gapped down and the zone was violated. So technically, you would have not been able to participate, because as a type 2, type 3 trader, we need a confirmation, and that confirmation never happened, and the prices, they gapped down. So that basically takes care of the only trade which got triggered. Was analyzed on the 20th of April. And now we can start with our example for today. So just give me a second. Let me bring that up. All right. So just a few more seconds. Perfect. So this is today's example. And like I said, once we go through the analysis, I'll talk about why it is a conditional trade. And like I already said, it's an example we are looking at for the very first time in the last 1.5 years. All right, so whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. If you're not yet watched that video, the link is available in the description. Do go through that video, very, very important. Cannot be skipped. And whatever process I've explained in that video, start with it. The sooner you start, the better it is going to be for your trades. So because we need to be mechanical and rule-based, what we need to do is we need to create a trade plan for us. Now, when you're learning trading as a fresher, or even when you're learning a new methodology, let's say in this case demand supply, it's not very easy to create a trade plan from day one. And that is where these two documents, they help you. So they are more like your ready-made trade plan, but they are a little conservative approach. As you start having more and more experience, you want to modify it based on your personality style. Those modifications can definitely be done, but at least you do have a starting point which can help you start planning trades very mechanically and very rule-based. So what is our step number 1 whenever we start planning our trade? Step 1 is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, it can also be the stop loss, any kind of exit. So now the question comes that why am I starting with the trade purpose as my very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that we have so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go in a very logical approach, and that logical approach is that the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, then what happens is that your market will close at some specific time, and then whenever is the next trading day, it will open. And I'm pretty sure all of you would have experienced whenever market opens, some of the symbols they gap up and some of the symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we are holding a position overnight in a market which is not a 24 hours market, we do have that add-on gap risk which cannot be avoided. And that is the reason my recommendation to all of you is that your hourly dailies should be strictly done as intraday trades. We don't want to have that unnecessary overnight gap risk by keeping these positions as overnight positions. Now, for weekly monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly monthlies, we cannot have gap against us. It can still happen, but the probability definitely reduces because the bigger the time frames you're using, the higher the weightage of those time frames. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight, can be done, but again, when you have that confidence. So step 1 is I need to define my trade purpose. Let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis. Because demand supply methodology is not based on single time frame, demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, the intermediate time frame ITF, the lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I opted, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate used for trend analysis. On the lower time frame, we identify our SETS. SETS stands for stop loss, entry, target, and size. And in this case, it will be the daily chart. And my refining time frame will be the 60 minutes, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames. I know what analysis I need to do on each and every time frame. But let's say if I take the example of NSE, on NSE we have over 2,000 plus companies listed. So humanly not possible that every day I sit and analyze 2,000 plus companies. So what we need to do now is we need to have a process in place for selecting a smaller list of scripts. And the way we do that is by using certain computer programs, which are called as scanners or screeners. And what these computer programs, they basically do is you input certain conditions into them, that these are the conditions I'm looking for. And then these computer programs, they identify that out of these X number of symbols which are available, which symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, the challenge is that if you do a Google search, you will be able to find n number of scanners, n number of screeners, I'll say n number of free scanners and screeners. But the problem is all those scanner screeners are either based on conventional technical analysis, or they are based on the fundamental analysis. So the challenge was that there were no scanner screeners for demand supply methodology, and that is where we have two custom built tools. One is called as the alert service, the other one is called as the demand supply zone screener. Now, how do these tools, they work? If you want to understand them better, you can click on them. You can visit our product pages. The walkthrough videos are available. You can go through the walkthrough videos and understand how they basically work. I'll also quickly tell you how you can do it on our website. So on our website under services, you have option which says trading view indicators. Go to trading view indicators, and here you can see you have alerts and screener. You can click on them. You can watch the walkthrough videos, and that will help you understand how these tools, they basically work. Again, I'll add these are scanner screeners which are purely based on demand supply zones. So whatever your approach might be, which can be as simple as I just want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of stocks which I want to analyze every day. So choice is yours, how you want to get that small list. But I just talked about that there are n number of ways it can be done. You'll find n number of free scanner screeners if you do a Google search. But if you're looking for a scanner screener which is specifically based on demand supply, then these are also the two options which are available to you. But always remember, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols, because the scanner screeners, they never tell you what you need to buy or sell. They only help you get a smaller list. Once you have that small list, you'll have to analyze them one by one and see whichever matches with your trade plan might be an opportunity for you. The one which doesn't match with your trade plan, you definitely skip it. So whatever your process was, apply that, get your list of symbols. Let's assume that in this list, I got the very first symbol as ABC. So what I need to do now is on ABC, I need to go to the lower time frame. And what is my lower time frame? We got the answer from our step number one, that as a monthly income trader, my lower time frame will be daily. And on the daily chart, I need to identify zone. Now, by zone, we mean any of these four structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. And the best part is we also have a automated indicator which automatically identifies and plots these demand and supply zones for us on TradingView. And we are offering a 100% free 7 days trial of it. So if you've still not tried our demand supply zone indicator, once you're on our website, you will see that under services, you have TradingView indicators. The very first one is the zone indicator. Click on it, and you'll be able to find this option which says 7 days free trial. Click on it, and you have to fill this form. Only 3 things are required: your full name, your email address, and your TradingView username. Now, in case you still don't, as of now, you don't have a TradingView account, then you can click here and sign up for a free TradingView account, and then you can provide your TradingView username. In case you already have a TradingView account, then you can click here, visit your profile on TradingView, and provide your correct TradingView username, because if you are providing incorrect TradingView username, it will get activated for someone else instead of getting activated for you. So do ensure that you're providing the correct information. After that, click on I'm not a robot, and click on submit this form. And once this form has been submitted within 24 hours, it will get activated for you. Once activated, you will receive a notification on TradingView that you have access to the indicator, and then you can try it for free for 7 days. So now, since everyone has that opportunity, they can access the indicator for free for at least 7 days. So whatever analysis we'll do it based on the indicator. In fact, even when a free trial was not available, I was still doing the analysis based on the indicator, because that definitely makes the process easier, faster, and mechanical. So let's assume this was the symbol which was shortlisted by whatever process I used in my step number 2. And as soon as I applied the indicator, can you see it is showing me that we have a rally-based rally structure available here. So my step number 3, which was to identify a zone, the indicator has done it automatically for me, and now we do have a rally-based rally structure available to us. So step number 3, which is identify zone, yes, we do have a zone available. And once we have identified the zone, does not mean we can trade it blindly. And that's the biggest mistake demand supply traders, they do initially. They see any demand area on the charts, blindly start buying on it. They see any supply area on the chart, blindly start selling on it, which is incorrect. You can never blindly buy or sell at any demand or supply area. Once these zones have been identified, the next step is to qualify them, which is a two-step process. In step one, we'll qualify them based on certain conditions, and in step two, we'll qualify them based on the booster scoring. So when we start with these conditions for qualifying the zone, the very first one is level on top of level. Now, why do we start with level on top of level? Because if the zone proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. So that is why if some modifications are required, we should make those modifications before we proceed ahead. And that is the reason level on top of level is the very first condition we check. Now, how do we verify this? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, the condition here is when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what this tells me is that to be a case of level on top of level, my lower time frame zone has to be completely inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, possibility is it might be a case of level on top of level. But if you don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? In this case, our intermediate time frame is weekly, and here you can see on the weekly we do have a rally-based rally structure available. So let's draw this. So that's my weekly zone. Let's change the color. Now the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes. So we do have a coinciding level. Now once we know this is a coinciding level, now we have to check, do we have only one zone inside of it or do we have multiple zones? Now, remember, whenever you're on your lower time frame, by default, the indicator is always identifying quality zones for us. But for cases of level on top of level, it is not mandatory that all zones might be quality zones. So that is why I'll go to the indicator settings and I'll check mark all demand supply structures, which means I just don't want quality areas. Anything that is demand, anything that is supply, identify that for me. And here you can see that inside of it we only have one zone, we do not have multiple zones. So that basically tells us we only have a coinciding level, we do not have a case of level on top of level. Now one thing which you people have seen me doing almost every time, that whenever I have a coinciding level, I prefer to have my stop loss from the distal line of the intermediate time frame. Now, is it mandatory? The answer is no. It's just that it's my preference. I am a little on the conservative side, and that is the reason I like to have my stop loss at a little safer location, which is why I have shifted my distal line to the distal line of the intermediate time frame. All right, so coming back to the analysis, it was not a case of level on top of level. Is the zone because of a gap? Now this is because of a gap, but I'll be skipping it as of now because today we are going to focus on something different. We already took a gap example some time back, so let's assume this was a regular rally-based rally structure for us. Now, pivot non-authenticity, we do not apply to rally-based rallies. We only apply pivot non-authenticity to a drop-based rally or a rally-based drop. So this is not applicable. And it is also not a structure of unstable equilibrium. So after looking at all these conditions, none of these conditions are applicable. And since none of these conditions are applicable, we cannot, they are not applicable, so they cannot disqualify the zone, right? To disqualify a zone, they first need to be applicable. Then there can be two possibilities, either qualified or disqualified. And since they are not getting applied, by default, it is a qualified zone for us. So now that we know we have a qualified zone, we'll move on to the next step, which is the booster scoring. Now in booster scoring, the first one is your freshness. The zone is definitely fresh, gets a score of 3. Talking about strength, we have an explosive move. That's the reason the indicator is marking it, gets a score of 2. Time at the zone, we only have one candle in the basing, which is again a score of 2, and reward to risk ratio will take as an assumption. So now talking about the probability, if we start with the location, we'll have to go to the high time frame, right? If you start with the location, you can see that this zone is located middle of the curve. Why middle? Even though it is overlapping two different areas, but we always check where is my entry point, right? So the entry point is middle of the curve. which gets a score of 0 because middle of the curve is not a very conducive location, not even very bad. So that's why we give it a score of 0. If you talk about the trend, if we go to the weekly time frame, which is our intermediate time frame, the indicator is telling us that currently we are in a downtrend. Now the trend is also not supporting us, which is again a score of 0. Move from the zone, we need at least 4:1, which has not yet happened, which is again a score of 0. Talking about level on top of level, we have already verified not a case of level on top of level. It was a coinciding level. And the trap, let's see if I take a horizontal line, wherever the proximal is, let's zoom out a little bit and start pushing it up, trying to find an area where the prices have been bouncing over and over again. So you can see this is almost a textbook example of support resistance. Can you see in the past almost has been acting like resistance, acting like support, acting like resistance. So we are right there closer to this area of support resistance, and the prices are currently just a tad below it. So once the prices go above, yes, this might work like an area of trap, for which I'll give it a score of 1. Now, the fact remains I'll give you a number of reasons why this is not a valid trade for us, but why I have still picked it as an example. So we'll talk about it as we move forward. Now, the first thing you'll check here is that the quality score is 10 and the probability score is 2, which tells us that this can be done as a type 2 or a type 3 trade. But the fact is, if I go to my action grid, in the action grid, what we are supposed to do, if you have a demand area on the lower time frame, and that demand area is located at equilibrium location, right? That is where we are as of now. And the trend is downtrend. We are not supposed to take any action here. So the very first thing is that even if the booster scoring is telling me it can be a type 2 or a type 3 trade, the first thing is the action grid is telling me I'm not supposed to take this trade based on my trade plan. This is not a valid trade for me. Right, but let's say if you're someone who does not follow this conservative approach, you are a little aggressive trader, then you can say, okay, for me, it is still a type 2 or a type 3 trade. So the first thing, based on our trade plan, by default, this is not a valid trade. But now, why I have taken it as an example, because if you go back to this trade setup, what you can see is that we have already hit the very high of the curve, right? So let's wait for a few seconds. Can you see that's my monthly supply, and we have already hit that monthly supply. Now in the rule book, there is a rule, and specifically for this rule, I picked up this example because we haven't touched upon this rule in the last 1.5 years. And the rule basically says that when the price comes to the zone from the higher time frame demand or the higher time frame supply. Now, what we are trying to do here is, let me try to help you understand. See, when we are planning trades, it's something like this. We have our very high of the curve, we have our very low of the curve, right? And then let's assume that on the lower time frame, let's say this was a lower time frame demand area, right? Let's assume this was the lower time frame demand area. This is my LTF demand zone. This is my HTF, higher time frame supply zone, which is used for curve analysis. This is my higher time frame demand zone, which is also used for curve analysis. Now, when we are planning our trade, the reason we are planning our trade is that we are anticipating that once the prices, they come to my demand, from my demand, it can keep moving up unless it hits this supply. And once it hits this supply, two things can happen. From the supply, it can again start moving down, or maybe eventually it might violate this and continue with this move to the upside. Right now, if the prices are coming back to my zone first, it's perfectly fine because this is what we are expecting. But what if prices, they don't come to my demand area, they keep moving up, hit my supply, and then they start coming back to my zone? And that is what is happening as of now. And that is what this rule is all about, that when the prices they come to your zone after hitting the very high of the very high or very low of the curve, the probability of the trade setup reduces. Now, why the probability reduces? To help you understand this, let's take a very simple analogy. A smaller time frame, you can see, is more like a kid, and the bigger time frame is more like an adult. So when the prices, they come to the lower time frame first, right? There is no adult opposing it. But once it has hit the very higher, the higher time frame zone, and then it starts coming back. So what is happening is, now an adult is trying to push something lower. What is the probability that kid can hold it? That probability is very low. Now, if you look at it with a trading perspective, right? The lower time frame is a daily chart. The higher time frame is a monthly chart. So now if you think about it, the number of orders which can get executed in a day versus the number of orders which can get executed in a month, there'll be a huge difference. So that is why we know that this supply can be much, much stronger than the demand which we might have on this particular area. So that is the reason the probability reduces. So what we need to do now is, if the probability reduces, what should be my action? So the rule says if you're a conservative trader, do not trade, right? So the first thing is, this is not a valid trade for me. I should not be taking the trade on this particular demand area. Now, if you still want to do it as an aggressive trader, you will be looking for certain conditions. What are those conditions? First and foremost, definitely we need required RR on the lower time frame and the prices are back. And second, because I know that I'm coming down from the higher time frame, I need now some support with my lower time frame. And what will be that support? That my lower time frame zone should be located at the best location on HTF plus 1. So in this case, my HTF was monthly. So monthly plus 1 in this case will be, I'll be taking the 3 months chart. So what I want now is that if I'm planning such a trade, then I need to ensure that this zone is located at the best location on my 3 months chart. And if I go to the 3 months chart here, you can see I don't have any demand area here. So let's change this to all demand supply structure. So you can see I don't have any support coming in from the 3 months chart. So again, based on the action grid, anyhow, it is an invalid trade. Based on what is happening as of now, can you see it's coming down from the monthly, then coming to my zone? It is still an invalid trade. Now let's assume if I still want to plan this trade. So like I said, this can be a conditional trade. Now what will be that condition? That if I want to plan this trade, I will wait for the violation of this monthly zone, the HTF zone, to happen. Because if this monthly zone gets violated, that basically tells me that the smaller time frame zone, which we can say was the kid, has some extraordinary strength, and that is the reason it has been able to defeat the adult. So that strength I want to see. So that is why going with the rule book, definitely an invalid trade for us. But yes, if you still want to participate, the only condition now we want would be a violation of this monthly supply. After violating this monthly supply, if it comes back to my zone, this can still be a tradable opportunity. But if it comes straight away from here, this is not a valid trade for us. And this was the idea behind picking this as an example today, even though I knew this is going to be a disqualified setup for us. But we haven't covered this example in the last 1.5 years of all the sessions that I've taken. So since this was a beautiful example of it, I thought let's just pick this as an example to understand this particular rule, which is available in the rule book. All right. So yes, moving forward. We already talked about, irrespective of whatever the booster scoring is, this is a conditional trade for us, and that too as a type 2 or a type 3 trade. So all other things we have already talked about in almost every other session. Next step is your position size calculation. You need to do re-verifications before you enter the trade. And once you are in the trade, then the last step is your trade management. So that basically takes care of today's example, which was a very beautiful example of one of the rule which we haven't covered for a very, very long time. And that's why I particularly picked up this example to touch upon that rule. And again, I'll add, if these sessions are helping you, do ensure you like the video. If you're not subscribed to my channel, do subscribe to it. If you have any friends or family members who are into trading, you can share the link to my course content, to the sessions, to the free trial of the demand supply zone indicator. Even if you're on some trading groups, I'd highly appreciate if you can share all these things, because I know a lot of people are struggling with trading. So you never know what might help someone. So that takes care of today's analysis. Now, at the end of the session, I definitely go through the questions queries which you people have. And before I answer them, I would also like to add that one feedback which we have been getting from you people was that during these YouTube live sessions, you can't share your analysis. So what if you want to share your analysis, or maybe you don't want to ask your questions publicly? So we have an option for one-to-one session now. So on our website, on the top right corner, you'll be able to find this one-to-one option. And from here, you can schedule an appointment. Two options are available: a voice call and an online meeting. If you feel that on a voice call, you can ask your questions, queries, and get done by it, you can schedule a voice call. If you feel that you want to share your screen, you can also go for an online appointment. All right. So, like I said, otherwise, you can always put your questions in the chat box during the session. And at the end of the session, I'll try to answer as many questions and queries as possible. So, let's see what questions we have. So, in the industry, I just said to be approximate 55%. Also, market is dynamic and evolves. Also, tech is evolving faster in long run. Is it still worth to stick with this methodology where edge might not work? See, the fact is, as long as the I'll say the universal what should I call it? The universal formula, you can call it formula, or universal reality, you can say. That is, demand always makes the price move up, and supply always makes the price move down. That remains as a fact. Nothing will change for the methodology, right? Because what we are doing is we are just trying to identify where those facts are. Because if the prices are moving up, it has to be because of more demand. If the prices are moving down, it has to be based on more supply. So yes, as long as that remains a universal fact that the demands are always increasing the price, the supply is always reducing the price, the strategy will always work. सर आपके कोर्स में डिमांड सप्लाई ऑप्शंस कोर्स ट्रेडिंग results are good. All right, so happy to know, Pratik, the course is helping you and you're getting good results with it. All right, perfect, great. So that brings us to the end of today's session. Thank you everyone for joining in. Next, I'll be seeing you next weekend. Till then, trade safe, enjoy your Sunday. Take care, bye-bye.